Okay, we've talked a little bit about cash flow. Let's talk a little bit about why cash flow and accounting income are two different things. So if you imagine, say I go into a bar and I order a beer, if I put it on a tab, I didn't actually pay for the beer. The cash register actually gets cash, and if I put it on a tab, I didn't pay for it. But they still ring it up as a sale. They still count it as that's what they sold that day, but they haven't got the cash yet until I pay for it. Now, a good example of that is my iPhone, because I bought that iPhone a while back, and I think I paid $199 cash for it at the time. But that's not what it costs. It cost probably 800 bucks, I think is what they cost, round numbers. And so every time I get a cell phone bill, part of my money is going to the cell phone bill. Part of it's going to Apple to pay for that iPhone. So they have not they've booked the revenue. It has hit the sales at the top of the income statement. They've taken out the cost of goods sold for all the parts and equipment that went into it. They've gotten rid of their sales and administrative costs and so on. They've gone all the way down, paid their taxes on it. As far as the financial accounting is concerned, it's done. However, we don't have the cash. And so am I going to stop payment on it? Are they going to collect this cash? These are all questions that we don't know. So cash is very important. As we can see here, we don't want to confuse cash and accounting income. Non-cash expense example would be depreciation. No one has ever written a check for depreciation. And so when you think about the income statement, you've got all these costs, and then you have this depreciation number, which we remove because we don't have to pay taxes on depreciation. Then we calculate the tax number. But before you do that, you get rid of depreciation. Well, depreciation isn't a taxable isn't a cash item. It's the fallen value of our plant, property, and equipment. And of course, that isn't cash. That's just happening. So when you think about cash flow and we think about accounting income, it's very important that we keep the two things straight. Sometimes we have accounts receivable that isn't cash, and that would hit the income statement, as well as a depreciation, which would hit the income statement. And so these two things make us adjust our income to cash flow as we go forward, because the way we're going to look at everything in finance is by cash flow. Cash is king, and so keeping accounting income and cash flow separate is very important.